In the final months of 2008, the global economy was minutes away from total collapse. We witnessed the unthinkable. Lehman Brothers vanished. AIG, a titan of insurance, required a massive $182 billion lifeline, and major world governments poured trillions of dollars into a desperate bid to save the system. Millions lost their homes, millions more lost their jobs, and the cost of the Great Recession was estimated to be in the trillions of dollars. But here is the central question of our story. Was this catastrophe truly inevitable? When we look back, the forces that led to the crash, subprime mortgages, financial engineering, and radical deregulation, look less like a natural disaster and more like a ticking time bomb built over 2 decades. Could a few key regulatory actions, taken years earlier, have diffused that bomb and steered the world away from its worst financial crisis since the 1930s? This is History Reimagined. Welcome. To prevent the crisis, you must first understand its core mechanics. First of all, the root cause, the mortgage market. The trouble began with the proliferation of subprime lending. These were mortgages given to borrowers with poor credit histories, often with little or no documentation, and featuring dangerous teaser rates, low initial payments that jumped dramatically after 2 or 3 years, guaranteeing failure for many borrowers. Next, the fuel, financial engineering. Investment banks took these inherently risky mortgages and bundled them together like kindling. They sliced and diced them into complex financial instruments called collateralized debt obligations, or CDOs. The trick was that rating agencies, often pressured by the banks, would incorrectly label the top tranches of these CDOs as AAA, or perfectly safe, allowing pension funds and global banks to buy what was essentially toxic waste. The last, probably the most important cause, 2 legislative acts fundamentally opened the floodgates. First, the repeal of the Glass-Steagall Act in 1999 allowed massive commercial banks, which hold federally insured deposits, to engage in high-risk investment banking, creating institutions that were truly too big to fail. Even more critically, the growth of credit default swaps, CDs, essentially insurance contracts on these toxic assets, was left completely unregulated, allowing trillions of dollars in risk to accumulate in the shadow banking system. So, the beauty of this counterfactual history is that prevention could have occurred at 2 clear, distinct choke points in the system. We'll explore 2 specific, realistic regulatory interventions that could have been made in the mid-2000s, long before the ultimate panic. First of all, can we regulate the shadow banking system earlier? The market for insuring the CDOs became exponentially more dangerous than the mortgages themselves. Institutions like AIG sold trillions of dollars worth of insurance, CDs, against these mortgage failures, but were not required to hold any capital reserve to back those guarantees. They were printing money based on trust. What if, in the early 2000s, Congress had granted the SEC or the CFTC clear regulatory authority over credit default swaps? This simple move would have required AIG and other institutions to mandate capital reserves, actual cash held in escrow, to back their insurance contracts. This would have restricted the size of the CDs market dramatically and prevented systemic failure. When the housing bubble burst, AIG wouldn't have instantly become insolvent, and the entire global banking system wouldn't have been paralyzed by the fear that its insurer couldn't pay up. The secondary intervention point was at the very start of the process, the mortgage origination. Mortgage lenders had every incentive to give out bad loans. They didn't care if the borrower failed because they immediately sold the loans off to the investment banks. This was the originate to distribute model. What if the Federal Reserve or another agency had implemented strict, ability to repay, standards for all mortgages? This would have banned risky products like no-doc loans, loans where you didn't have to prove income, and preemptively capped the sudden jump of adjustable-rate mortgage (ARM) hikes. By making it impossible to originate the toxic loans, the prevention would have effectively starved the CDO machine of its required bad inputs. Without enough junk to bundle, the financial engineers wouldn't have had the fuel to create their global financial weapons. Therefore, the prevention of the GFC would not just have saved banks, it would have fundamentally altered the 21st century's trajectory. In this alternate reality, the housing market never experiences the massive, unsustainable bubble of 2004 to 2007. There is no irrational exuberance, no massive increase in household debt. Growth is slower and less dramatic, but the underlying economic foundation remains solid, avoiding the painful reset of 2008. The slower but safer growth would bring a more stable economy over boom and bust. The need for the collapse of major institutions like Lehman, Bear Stearns, and AIG is averted. Trillions of dollars are not spent on public bailouts and quantitative easing, allowing governments around the world to focus on crucial long-term investments in infrastructure, education, and social programs rather than propping up the financial sector. What about its impact on political and cultural landscape? In this alternate reality, the Great Recession fallout is unlikely to occur. This is perhaps the most profound change. The extreme unemployment, the wave of foreclosures, and the mass destruction of household wealth that occurred in 2008 to 2010 are avoided. This prevents the mass anger, disillusionment, and intense anti-establishment feeling that fueled populist political movements globally. Without the economic trauma, the rise of the Tea Party in the US and the deep distrust of established elites and globalism would have been significantly muted. On the other side of the world, Europe avoids the prolonged, debilitating Eurozone sovereign debt crisis, which was directly triggered by the GFC. Nations like Greece, Spain, and Italy are spared years of brutal austerity, leading to more stable EU politics and potentially a healthier, more unified union today. So, since no crisis forced global institutions to consolidate further, the too big to fail banks remain smaller, and the financial system is far less interconnected and less risky. Without the fear of systemic collapse, financial markets would be forced to prioritize long-term investment and value creation over the creation of complex, high-risk, short-term speculative instruments. The banking system would be boring, and that is exactly how it should be. In our summary, the 2008 global financial crisis was not an act of God. It was the predictable result of specific regulatory choices and omissions made by policymakers and regulators who prioritized deregulation and innovation over caution and transparency. Preventing the crisis would have been a triumph of foresight, a demonstration that prioritizing stability over short-term financial profits is the only way to build a truly resilient economy. This thought experiment still leaves us to ask tough questions about human nature and politics. Would slower, safer economic growth have been politically acceptable to the public and politicians during the mid-2000s boom? If the financial system never failed, would the political will have ever existed to enact the reforms we now have, like the Dodd-Frank Act? And finally, in a world driven by innovation and profit, is a major financial crisis ever truly avoided, or is it merely delayed until the next generation forgets the lessons of the past? Thanks for watching the videos today. Don't forget to share and subscribe for more stories.